Hello, boys and girls. Welcome to the video today. So, today I want to share with you my concerns with the current stock market worldwide, the current valuations, the debt to GDP, and interest rates are in unprecedented levels, and therefore the risk is a lot higher than usual. So, I want to discuss that with you. Bear with me, I'm gonna walk you through my calculations and my thought process. If you just want to understand the summary of this video, just the idea is that I do believe that interest rates are way too low. So if that crisis comes up, we don't have any interest to cut to stimulate the economy. The debt over GDP is already at astronomical levels. So there isn't that possibility of borrowing more money as we did extensively in 2008 to get out of the crisis, and P ratio, which means price per earnings of the stock indices across the board, are at very, very expensive levels too. So that's the idea of this video. And then I will show you how to kind of adjust your portfolio to bear that risk a lot wise, a lot wiser than it is right now. Okay, so without further ado, I've listed the top 12 countries in the world by GDP measures. So column A, you've got the name of those countries, and column B, you've got their GDP in dollar amounts as of today. So we are in the end of January 2021. So as you can see, the top 12 countries, they have in total about $61 trillion in GDP, whilst the global amount of money in the world is $135 trillion of annual GDP. So, what I did is a percentage of the global GDP in each one of those countries. As you can see, China is actually reaching the US, and I bet you that in 5 years they will be there already because they are growing at around 6% on average, whereas the US is about 2. But as you can see, if you sum up those 12 countries, they are responsible for 45% of the global GDP. So they are a very important chunk of countries for the global market. So meaning that if those 12 countries they have any problems, they will probably have a global wide crisis. There wouldn't be a way to get out of it. So the column D then is the interest rates, right? So what does that mean? That means the amount that money is worth in each one of those countries. So should you not spend the money today, how much would the money be worth in a year from now? So for instance, in the United States, that money would be worth 0.25% more. So if you have $100 today and you don't spend that $100 in 1 year, that $100 would be $100.25. That's what it is, literally. As you can see, there are a couple of countries that I highlighted in green for specific aspects. So in terms of interest rates, you can see that China, India, and Russia, they are still in okay positions. Now, how do you define okay, right? So what I did is the historical averages, the weighted historical averages. So what does that mean? So that means that if you see this formula here, what I did, I kind of multiplied the amount of GDP to their interest rates. Why did I do that? Because the effect of the United States in the global economy will be much larger than the effect of Brazil. Why? Because their economy is about 21 times the size of the Brazilian economy. So, therefore, even though their interest is 0.25, you need to get a weighted average that their economy will be more important than the Brazilian economy, than the Russian economy, than the South Korean economy, than the Canadian economy. So that's why I did that way. So in terms of weighted average, we have right now the interest rate weighted average of 1.42. In the historical average from 1970 to 2020, that amount would be 10.25%. So you can see that already that, on historical standards, we are 10 times lower than usual. So if a crisis comes along, the usual first response is to cut interest rates. That's monetary policy 1. So that's the first thing that the central banks would do. Now, if that reaches 0, you're pushing on a string because you can no longer cut interest rates. So you can see Japan trying a little bit more, going with negative rates, but negative rates are very uncertain. We have no evidence that they actually stimulate the economy further. Whilst we do have evidence that interest rates stimulate the economy a lot, they are the most effective tool until it gets to 0. So you can see there that India, Russia, China, and Brazil a little bit, they have still a little bit of powder to use, gunpowder to use. The rest of the countries, that's completely done. The monetary policy too is that. So what do countries do? First of all, they buy ETFs, they buy assets, and they print money to do social checks, as the US and UK are doing, to pay for furlough of people. So the governments, they foot the bill, right? So, however, there is a point of which that the government is no longer able to increase their balance sheet because their debt is too high. As anyone who's ever seen credit card bill, you know that when your debt is too high, it's very hard to get out of it. So it's very likely that the country defaults and goes bankrupt. So that has happened with Russia before, that has happened with Brazil before, and most recently, I think you're gonna think of Greece, you're gonna think of Italy, which, by the way, Italy is during that crisis 10 years later. You're going to think about Venezuela. So it's a very difficult position to be in. So countries, as soon as they reach, over 100%, they get very cautious. So as you can see, if you go along, you can see, for instance, US 131%, China 185%. China, you won't see if you Google it, just China, debt over GDP, because China hides a lot of its government debt into its state-owned enterprise. There are a lot of enterprise that are owned by the government that has huge debt. So that's why the public sector debt is what you need to look at in China, and they are about 185% to 100%. Japan, 266%. So if you went to school, in the 80s, the 90s, your teacher would probably be saying, well, you should invest in Japan because that's the economy of the future. Well, it's no longer, because the debt in Japan is so high. Together with the population decline, Japan has been basically stagnated for 30 years. And those are the reasons why. Germany, very, very good levels of debt over GDP. Germany is very careful with this. They want to lead the EU by being a role model in terms of debt. UK, 108%. India, 75%. France, 119%. Italy, 158%. Canada, 95%. Korea, South Korea, 40%. Russia, very good levels, 19%. Why does Russia have 19%? Well, it's easy, because they default on their debt in 1999, where they had a problem with that when they had only, by the way, 80, 90%. But their debt was a lot denominated in dollar instead of their own local currency. So they had to default on their debt. And that's why currently you're going to see that the Russian market, it's a very hated market, because even though they have quite good statistics as compared to the rest of the world, their P ratio is very low. What does P ratio mean, you may ask? Well, that means price per share divided by the earnings per share of that company. Again, maybe you didn't understand that. What does that mean? That means that a price of 1 unit of a company divided by the profits of 1 unit of the company. Let's say you go and buy a productive asset like a farm. You buy that farm for 1,000, but every year that farm produces $100 of profit. Therefore, that farm's P ratio is 10, which is 1,000 divided by 100. So the higher the P ratio, the more expensive the asset is. Conversely, the lower the PE ratio, the cheaper the asset is. So as you can see, the Russian index, which consists of the largest companies in that particular country, is only 11, whilst in the United States it's 39. So before we go further into PE, let's finish off with the debt over GDP. So Brazil 101%. So as you can see, the top 12 countries have a weighted debt over GDP of 131% versus historical basis. The same countries from 1970 to 2020 have had a historical weighted debt of 68% over GDP. So we've done interest rates and debt over GDP, and both of them show very worrying signs. The next one, we're going to look at P ratio. So on a historical basis, what's considered cheap and what's considered expensive, right? So 10 is cheap on a historical basis. 20 is considered expensive. So I actually have a graph here of P ratios of S&P 500 just to show you that mostly is being going on since 1850 is being between 10 and 20 with a few anomalies. By the way, here's 25, here's 5, here's 20, here's almost 5 again. But biggest anomalies were during crisis, and our worst crisis in modern history were in 2000, and we actually reached 40, and 2008, which went through the roof. And now, again, end of 2020, beginning of 2021 is almost 39, which is very worrying sign as well for our PE ratio. Here as well, I've got you an example of how interest rates actually can save us from recessions, but can also put us into recessions. Those are all the seasons where interest rates were manipulated in order to get out of crisis, really. So this is interest rates in 2018. This is in 2008. So you can see the cut in order to get out of the crisis. In 2000, here is in the 90s when we had the emerging market crisis. Here are in the 89 where you had the Black Monday, the Continental Illinois failure in the 80s, early 80s, and then again U.S. saving and loans crisis in the early 80s. So you can see the influence of interest rates, and you can also see the historical thing, right? So at one point, about 40 years ago, interest rates in the US were 18%. Right now, they're 0.25. It's unbelievable, right? Nobody would ever predicted such a thing. And many people say that we are in this situation right now because after we got out of the 2008 crisis, it took us a long time here to recover the interest rates. And the debt over GDP is a lot higher because a lot of stimulus occur. So you got the Trump tax cuts, you've got a lot of money printing to get out of both crisis 2008 and now COVID-19. So moving on to the PE again. So you can see that the US is super expensive, but you would expect the US to be expensive. Why? Because their stock index is mostly formed by tech companies. So if you look at, the S&P 500 composition, you're going to find a lot of US companies. So therefore, somehow they are expected to be around, 20 P ratio. So I'm going to show you how much of the top 10 holdings are of the S&P 500, more or less. This is the Fidelity Fund, but it follows more or less the same template. So the S&P 500 index has 6% of the index into Apple, 5% into Microsoft, 4% into Amazon, 2% into Facebook, and then again 3% into Google, And then those are pretty much, you know, tech. So 20 the top 10 holdings are 25%, 28% of the S&P 500. And that basically means that, the tech stocks here are about 25% of the US index. Because tech, they are expected to grow a lot faster than the rest of the industries versus, basic goods and things like that. P/E ratios are supposed to be higher in tech. So if the S&P 500, which is the US stock index, is 25% tech at least, because those are the biggest companies, then 25% maybe P/E ratio are quite understandable. But 39 is very, very hard. Why is that hard? Because that basically means that when the GDP of the US grows, which basically represents the profit of the companies operating in the US, when it doubles, their P ratio will then be 20 instead of 40. So then you can see that the GDP in the US economy really needs to follow that P ratio to be at sustainable levels. That P ratio is trying to identify how much would that company be worth in the future. So usually that calculation is made through interest rates, but when interest rates are zero, which is the opportunity cost of money, you tend to use inflation. Inflation in the US has an average of 2% a year. So through compound interest, that basically means that in about 40 to 45 years, growing inflation at 2%, investors would bring the P ratio of the US market to have where it is now to 20, which would be understandable. So which option do you think is more likely to happen? Do you think it is that the valuations continue to be as they are now for 40, 45 years, or is there a correction in the market that brings the valuations down? Well, there are the two lines of thought, really. The first line of thought is that, well, interest rates are so low that you don't have any option. You cannot put into bonds, into government, paper, because they are only paying you 0.25, 0.5%, which is nothing. It doesn't protect you even against inflation. But there is also the latter point of view, which is the stock markets are due to a correction, and therefore you should take the money out of there, which, by the way, is the view that I hold. Um, Nobody can say whether someone is right or wrong in the stock market, but you can prepare, right? So if you think that the stock market is riskier than in the past, then you should adjust your portfolio accordingly. How do you adjust your portfolio? Well, you move around from stocks into bonds, from small cap companies, so small companies into big companies, from banks and highly leveraged industries into basic goods industries. So from cyclical industries such as car manufacturers into, defensive industries such as food manufacturers or discount supermarkets. So those are ways to actually adjust your portfolio to a more defensive portfolio that, if a stock market crashes, you're gonna lose less than if you were in it. But yes, you cannot. Nobody has a crystal ball. You cannot predict exactly when, but you can prepare. Bear in mind that the last sustained crash, was in 2008. 2020 it crashed, but it got quickly recovered. Why? Well, because the Fed and the other central banks start buying all the ETFs, start buying all the assets to make sure that it didn't hit rock bottom. But probably next time they will have very big trouble doing that because of the level of debt over GDP and because of the low interest rates. And if they do, they're going to create a lot of inflation. So that's why we're trying to protect ourselves through adjustment of portfolio. But let's move on because I digress. The P/E ratio was 39, and you can see why, right? Because in the last 5 years, the performance of the S&P 500 was 104%. So should you just buy the S&P 500 index and do nothing with your money other than that, you would have had double your money in 5 years. So very strong performance. And China P/E ratio is quite okay, 17.5 is probably where you would expect to be. China, I think China has still a bit of lee room, so that's why I'm not buying US stocks, I'm buying Chinese stocks right now. They can still cut interest rates further. They probably cannot put more debt in, but their P ratios can grow a little bit more. The last 5 years, only 30%. So China hasn't been as loved as it should be. So an investor, a value investor like myself, I like to buy things that are cheap so I can sell them when they get expensive. Japan, Japan is a debt country for me because honestly, I don't know how you can grow with that kind of debt. Their PE ratio is high and their performance has been low. I would stay out of Japan always. Um, but that's the thing about the stock market. If everyone thought like that, then Japan would become cheaper. So you can only earn money in the stock market if you have a contrarian view and you're right. It takes those two things. Germany, 0% interest rate, but still can increase that the P ratio is very, very high in Germany because they only have 30 companies in the DAX 30 index that they have. 30 companies that really push the country. So that's why they're super overvalued there. You can probably still find a few bargains in Germany, but you really need to hunt that instead of buying the index. 42% in the 5 years. UK. UK had the worst performance in the last 5 years, probably because of Brexit. Interest rate zero, 108% debt over GDP, and 20.7 P ratio. I do like a few of the bargains in the UK market right now, such as like BP oil and Unilever, but that's it. India is one of the green countries because I do feel like that they have opportunity for more investment. They still have 4 interest rates, 75% debt over GDP. Quite high PE ratio for India, to be fair, driven by the 96% performance in the last 5 years. France, not in a good position to be in, and only 26% over the last 5 years. Again, Italy. Italy has a very low P ratio, but it's the same situation as Russia. Their companies are mostly in basic goods, utility companies that in nature they have low P ratios because they are not expected to grow much in the future. But I would not invest in Italy. Canada P ratio very, very high. Would not do that either. Korea a little bit better than Canada because it has lower debt, but still P ratio is considerable. Russia, I would say that is the most undervalued market in the top 12 countries right now. P ratio quite low, debt quite low, still has interest rates. Last 5 years performance 96%, very good. Brazil has very much recovered from their last crisis from a stock market point of view, has grown 190% over the last 5 years. You would pretty much have tripled your money if you put money in Brazil in about 2016 and held it to now. But right now it has 100% of that over GDP and 2% interest rates and 32p ratio. I would not put my money there. But what matters the most is actually the weighted thing, because bear in mind that if there is a global crisis, even though Russia and India would be in a better position than the others, they would still decline because the world nowadays is very, very globalized. So therefore, one trickle here impacts everybody else. But that being said, whilst you can expect, for instance, a decline of 50% in the United States, that's how much 2008 declined for. So let's have a look there quite quickly. So S&P 500 history, and so for instance, S&P 500 history 2008, peak of the crisis here. I would just pull, even though the maximum that has declined in history, the crisis, was about almost 55% for the United States. During that same period, you're going to see that every single index declined, but some decline more than others. So I'm checking Brazil because Brazil fared quite all right from that crisis, not as bad, but it still suffered immensely. So 48% instead of 55%. Even though they were in a better position, they recover faster. They still suffer with the crisis. So you need to place a lot more importance in the weighted average than the individual countries. That's the reality. And so the weighted average right now in the PE ratio is 29.5, whilst over 20 is considered quite expensive. So very expensive. Over the last 5 years as well, performance has been weighted average 63%, whilst the historical average is 36.4 in 5 years. So we've had quite excellent performance in the last 5 years, double digit versus historical averages. And again, interest rates 10 times lower than historical. So with all that in mind, I want to show you what I'm doing with my own investments. So what I'm going to do right now is show you how I would adjust my pension. So even if you think that you don't have anything to do, you should still consider how you can adjust your portfolio meaningfully.